Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Greetings. This is Ivan Elon, the founder and chief investment officer at Align Wealth Advisors Investment Management, also known as AWAIM. I hope you're having a great day, and I would like to share with you some insights on what's going on in the U.S. economy right now. It's something very interesting, and this subject that I'm about to speak about, which is credit card delinquency, and its significantly and rapidly increasing levels that we've seen in the 90-day delinquency rates with credit cards here in the U.S. We also have a research highlight that is published on our website, alignwealth.com, A-L-I-G-N-E, wealth.com. So you can go there and actually see the chart that I'll be referring to, which has a few different metrics on it, including the rate of credit card accounts that are delinquent by 90 days or more, also the total amount of credit card debt, also looking at the interest rates charged on many of these credit cards, and the private savings of households. And those four metrics are highly correlated with one another. And something that is quite striking when you look at this chart and you just look at this data, and we're showing a good 20 years worth of data going all the way back to essentially January 1st of 2000, so 23 years worth of data. It's quite striking because you can see that the amount of interest rates and the level of the interest rates on credit cards is at a very, very high level, not something that we've seen in more than 2 decades. Nowhere near it, actually. It's currently at around 21.5%, 21.47% to be precise. And for most of the past 20 years, the credit card interest rates hovered closer to around 13 some odd percent. In the research highlight itself, I specify 13.73%. And so this 21.47% is about 56% higher than the 23-year average. So it's a huge increase in the cost of keeping debt on credit cards. And then at the same time, the amount of debt on credit cards has exploded from, and just within the past couple of years. I mean, right after the pandemic, it was paid down significantly to a level that essentially where it was back in 2016. And then around right after 2020, early 21, the amount of total credit card debt was somewhere around 780 billion or so. And lately, it is now around 1.13 trillion as of the beginning of this year. So that is a huge increase from 700 billion to over a trillion in just a couple of years. And of course, what that is correlated with, inversely correlated with, is the amount of savings and cash that households have been having on hand. And so just after the pandemic, of course, with all that helicopter money and all that government money that was sent out to U.S. citizens and businesses, there was about $4.4 trillion in cash. And now we're seeing about 800 billion or so. So this has been a huge plummet from the highs seen just after the pandemic. and then another kind of peak just under 4 trillion when there was that second round of fiscal stimulus that came out in 2020. And here now today we see that it's gone from that 4 trillion, over 4 trillion mark in just a couple of years down to under a trillion at 800 billion. So the amount of money available, readily available, liquid to households has shrunk, 70% essentially, and that's quite significant. While the debt has ballooned significantly, nearly doubling in the past couple of years on credit cards. And of course, rates have gone up significantly. Around the pandemic, when it hit, all the way through 2020, interest rates were around 15%, and now nearly 600 basis points higher, over 600 basis points higher at 21.47. So this is quite challenging, and so this is the backdrop, and so it isn't a surprise that we're seeing the level of delinquencies increase very, very rapidly from just a couple of a few months ago. Within the past, I'd say, year, you've seen it go from 7.5% delinquency rates to 9.74% delinquency rates, and that's quite significant. And that really looks similar to what we saw just coming out of the pandemic. But prior to this, the last time that we saw this kind of rapid rise or rapid level in delinquencies was right around the great financial crisis of 08-09, that recessionary environment. So it isn't a shock that we're seeing these 90-day or more delinquencies beginning within the credit card environment, given this backdrop of much less cash on hand to pay down debt, and at the same time, looking at the kinds of jobs we're seeing in the unemployment's ticking up a little bit. Some of that is due to people coming back into the labor force, and that can be a good sign. The only problem is the job openings are significantly less, and the jobs that people are getting are part-time jobs or the government, a lot of government jobs. So there really is this underlying shift that is occurring within the labor markets. There is tension, there is some stress there that is not highly visible at this point, and certainly a high degree of ongoing consumption that is seemingly keeping the economy rolling in this very quote unquote healthy fashion, and continues to be growing and having some growth. A lot of that can be attributed to the top 1%ers, whose income and investment earnings continue to be quite strong. And certainly with the wealth effect being what it is, with the stock market, people are feeling pretty good because the stock market has been hitting new highs. So there's a lot of underlying stress in the economy that is being obscured by potentially this small fragment of consumers within the economy that is obscuring the real challenges that most Americans are facing. And clearly, when you see increases in delinquencies with things like credit cards, or seeing just a significant jump higher of balances themselves, and of course, knowing that these rates are much higher, this is a great stress and obviously is reducing the disposable income available to many American households. So this is certainly something to continue to watch and monitor and be aware of. It certainly impacts our portfolio allocations and how aggressive and how much we would be leaning into equities at this point in time. More in favor of cash, more in favor of fixed income, very specific segment of fixed income, still very much on the low end of maturities, low end on the duration spectrum, very short-term bonds, and not taking credit risk still at this point, as all of these types of concerns are still percolating beneath the surface. I hope you found this insight and this deep economic thought helpful or interesting today, please feel free to reach out to me anytime at alignwealth.com. That's ALIGNE wealth.com. And we have contact forms on the website. Feel free to submit any questions or topics that you're interested in, or simply to set up a meeting. And we can obviously chat further about your specific situation, whether you're a financial advisor managing money for others, and reviewing our ACGM Total Portfolio Solution Suite and how that may be helpful to your clients, or if you're a direct retail client looking for a portfolio review from how your strategy is currently being implemented. Happy to chat with you further. Take care.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilorn.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.